Hello and welcome to Financial Intelligence. I have tried many forms of passive income ideas in the past, including peer-to-peer lending. In this video, I want to discuss whether generating passive income through peer-to-peer lending is worth it or not. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you won't miss any of my future videos. Peer-to-peer lending, or P2P lending for short, is a relatively new approach to the borrowing and lending experience. P2P platforms are called peer-to-peer because they bring regular people, in other words peers, together to participate in two sides of the same lending transaction. By cutting out traditional financial institutions like banks, borrowers may be able to access funds quickly and investors might get a healthy return. As an investor, you become the bank for somebody else who needs to borrow money. All the transactions are carried out through a specialized online platform such as Lendingclub, Prosper, or Upstart. Here are the typical steps involved in a standard P2P lending process. A potential borrower interested in obtaining a loan completes an online application on the peer-to-peer lending platform. The platform assesses the application and determines the risk and credit rating of the applicant. Then the applicant is assigned with the appropriate interest rate. When the application is approved, the applicant receives the available options from the investors based on their credit rating and assigned interest rates. The applicant can evaluate the suggested options and choose one of them. The applicant is responsible for paying periodic, usually monthly, interest payments and repaying the principal amount at maturity. Advantages and disadvantages of P2P lending. Peer-to-peer lending provides some significant advantages to both borrowers and lenders. For investors, P2P lending generally provides higher returns to the investors relative to fixed-rate investments that currently pay next to nothing. For borrowers, peer-to-peer lending provides a more accessible source of funding than conventional loans from financial institutions. Lastly, both investors and borrowers benefit because online platforms have made the entire process quick and easy, plus they have removed the middleman, lowering origination fees. Nevertheless, peer-to-peer lending comes with a few disadvantages for investors. First, many borrowers who apply for P2P loans possess low credit ratings that do not allow them to obtain a conventional loan from a bank. Therefore, a lender should be aware of the default probability of their counterparty. Second is that the government does not provide insurance or any form of protection to the lenders in case of the borrower's default. Finally, the biggest disadvantage for lenders/investors is that competition between lenders/investors, especially on larger platforms, puts a downward pressure on interest rates you can charge from borrowers. Risk/return profile of P2P lending. Risk and reward is the biggest consideration when it comes to P2P lending. Some of the potential returns might excite you, but realize that they are riskier. Let's look at the typical returns published by the Lendingclub, which is one of the largest P2P lending platforms. Lendingclub reports adjusted net annualized return of their loans by grades. Each loan is assigned a grade, A to E, with the higher grades being the safest and having the lowest returns. They used to have an F and G grade but discontinued those in 2017. When you combine all grades, the adjusted net annualized return has been around roughly 6% as shown in this chart. In order to put this number into perspective, we need to take into account the inflation rate. In other words, we need to know what percentage of the principal that is earning 6% annually is lost to inflation at the end of the year. Currently, the Consumer Price Index, or CPI for short, which is the official metric used by the US government to track inflation, stands at 5%. Therefore, if you invest your money with Lendingclub for 1 year to earn 6%, you will lose 5% of the principal to inflation, leaving you with a mere 1% real annual return. This is a very low return on investment for the amount of risk investors are taking on. Furthermore, many believe that the CPI numbers are intentionally manipulated to understate the real inflation rates. There is actually an interesting website called Shadow Government Statistics, www.shadowstats.com, that reports the CPI numbers without the modifications made by the government. This data shows that the actual inflation rate is twice as what the government claims it to be. Therefore, if we take the more accurate indicator of inflation into account, P2P lenders are actually making 6% on an annual basis on average when their principal is losing 10% of its value to inflation. Therefore, I would argue that P2P investors, given the current high inflation environment and low annualized returns, are actually ending up losing money. I hope that you like this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you won't miss any of my future videos. Thank you and take care.